Hey, everybody, welcome to the Under the Hood podcast. This is your host, Tim Douglas. And today on the show, we have Al, and we'll be talking about 1031 exchanges, 1033 exchanges, DSTs, and opportunity zones. Does that sound good, Al?
That sounds great. Looking forward to it, Tim.
Hey, everybody, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. This is your co-host, Tim Douglas. And today on the show, we have Al DiNicola with Naples Asset Management. Al, how you doing?
Hey, I'm doing well. Good to see you again, Tim.
Of course. Good to see you as well. Happy to have you on the show. And we always like to jump right in. So if you could start with telling us a little bit more about your story, your journey into the financial space, that'd be great.
Well, thanks a lot. Actually, my journey into the financial space started a long time ago. Around 1986 is when Tim, I think that was before you were born, right? Almost.
13 years before.
I got my first securities license in 1986 when we were selling a condo hotel on the beach in Hilton Head Island, South Carolina. And then been in the real estate development business most of my life. Then the last 12 to 15 years have focused more on the alternative space with alternative real estate developments, raising capital, and then also helping high net worth individual with their investment portfolios of real estate. So been in the business a long time. I've done in the real estate business a long time. Got my broker's license in 1981 in the state of Florida. So I've been a real estate broker for a long, long time, done commercial, residential, and development business. But more recently, in the last 15 years, have been in the alternative real estate space. So that's sort of how the journey's been.
What kind of made you make the switch from active in development to more helping high net worth individuals with some of the alternative stuff you help them with today?
You know, that's a good question. It's interesting when you look at your careers, you say, okay, how many years do I want to dedicate to a certain path or in a journey? And I had a great time working in a development business, worked with both private and public companies in the real estate development business in Naples, Southwest Florida, mostly in that area, a little bit of tour duty up in real estate tour duty up in South Carolina and up on Cape Cod. But after many years of running large projects of going out and acquiring 2, 3, 4,000 acres of land, helping with land planning, building golf courses, marinas, facilities, and those things, and then running large sales operations, you get to a point where you want to see, can you do a little bit different business, but then still be involved in the real estate aspects of investing without having to do the day-to-day operation of managing a staff of 20, 30, 40 people. So I think that's what's kind of driven me. And most of my interest has been in one-on-one with investors now, mostly individually investors, not institutional investors.
I can see how managing a team of 20 to 40 people on these huge projects, huge sales operations can be taxing from the day to day, and how stepping out of that, working in a more one-on-one, a little bit lower key, a little bit more relational, still in the real estate, still big deals. I could see why you would want to make that shift after so many years.
It also affords you with maybe more flexibility in focusing on your work and development as an individual so that you don't have to be 9 to 5 or in many cases 7 in the morning till 6 at night on a real estate site, single site or even multiple sites, and then focusing more on building a platform where you can have insight or share your insight with other investors.
Yeah.
So I think it's why I made the shift.
Talk to us a little bit more about, I guess, where you go to stay up to date with the latest market trends, latest financial strategies to help investors out in the ways that you do, and also shed some light, because I know there are some specific ways in which you help them out. So dive a little bit into that, and then where you go to kind of stay sharp on it, if you will.
Well, if there's any older real estate agents or brokers out there that remember the days when we have to wait every Tuesday for our MLS books to be delivered to the realty offices, and then we'd thumb through the black and white pages of the real estate books. I mean, information is no secret. That information technology has just driven the acceleration of a lot of different platforms in many aspects, not just real estate and investment, but you name it across the board. And now, I don't know if I have my seatbelt buckled fast enough for the AI that's coming down the pike with all the things that come out. It's almost like it's the old tape. Is it real or is it Memorex? Is it a real article or is it an AI article? You don't know. I don't know how to tell yet. I'm still working on that. So I think what's happening when you take a look at how do you keep up to date, naturally, we as financial advisors, we subscribe to financial newsletters that get dumped in our email box every week, it seems, or I'm actually every day, on different articles. So you look for keywords on, and you put your antennas up of what aspects, whether it's alternative investments or real estate investment trusts, Delaware Statutory Trusts, or the keywords of the business that I'm involved with, would sort of pique your interest. Then the other thing that you look at is how do you keep up with the due diligence that's required for any type of investment, so that you make sure that the product that you're suggesting to the investors are suitable. I mean, all of the clients that we deal with, and I'm sure all advisors do this, they take a look at the suitability or compatibility of the investor with the alternative investment or any type of investor that they would have to do. So keeping up with those items are very important. So, like a lot of financial advisors, I'm sure we participate in third-party due diligence meetings where we travel. We actually get on a plane and we fly someplace, and we sit in a 2 or 3 day meeting and look at due diligence materials that are provided by third-party reviewers to make sure, hey, have you thought about this? Can you look on page 125? What's on this? What does this mean? So I think staying up to date of it, there's a lot of internet-based and feeds that come through. But it's interesting. It's still not like getting on a plane, which I will do in a couple of weeks, and fly to Dallas and meet with a half a dozen sponsors and some due diligence people that we want to take a look at materials. And the face-to-face interaction is what they call me old school, I guess. I like looking at people in the eyes and understanding, what are you offering, why are you offering, and how does my individual investor benefit from whatever you're promoting this month.
Yeah, no, absolutely. So it sounds like you're getting your information from a mix of, you got the newsletters hitting your inbox every day, but it's also out there doing the work at the conference, in the 2 to 3 day long due diligence meetings, flying out to actually meet the sponsors, see them eye to eye, be like, hey, what does your product do for my client? I like that because it's easy to jump on a Zoom call or a Teams call or Riverside FM to record a podcast. It's a whole nother thing to get out there and see people in person, which is where we met actually at one of those conferences. We were at the Fact Right conference.
That's right. That's right.
Not too long
That's
ago
right.
there.
The other thing that's interesting, and I had a conversation with my wife. It wasn't this last conference. I think it was last year, maybe at the, I think maybe it was at a DISA conference. I listened to a speaker. The speaker was talking about a subject matter that I had mixed feelings about. And then the author was giving away a free book. And it was only a 250 pages book, but it took me probably, I want to say, a month to read it, because I'd read a chapter and I put it down and my wife would say, "What's wrong?" She says, "I can't read anymore. I just it's not in my lane. It's not what I was thinking about." But it was interesting after I plowed through the book. My wife says, "Hey, did you learn anything?" Well, I said, "You know what? I did learn something. You have to look at things from a different perspective sometime without giving just a knee-jerk reaction and say, 'Well, I don't believe in that.'" So I think any of us at our career levels, we need to take a look at maybe some other information that we would not normally read, and just read it for what it is, and understanding why the author feels the way that she did or he did.
Yeah.
So you always have to read it, the other side of the coin, the other side of the page, to understand, hey, how can I benefit from this, or how can my potential investors benefit from this?
I love that. Stay open-minded, because we're definitely not right all the time. That we can count on that. And so being open-minded to when others may be right is always a good rule of thumb. So I do want to jump into a little bit of detail about your specific area of expertise. We have 1031 exchanges, DSTs, kind of that alternative side of the coin. Talk to us a bit about what each of those are and like when somebody would use them.
Okay. So the 1031 exchange, and you may hear like kind exchange, you may hear the word Starker exchange. It's come about the last, I guess it's been now a little over 100 years that it's been part of the Internal Revenue Code, the 1031 tax deferred. That's not tax eliminated, it's tax deferred exchange, which enables you to defer taxes, capital gains taxes on potential income if you replace the property that you're selling with a like kind property. And there's regulations on timing, when you have to identify property, when you have to close on property, and also financial requirements on reinvesting all the proceeds, trading equal or greater value, and also replacing any debt that may be paid off on the property that you're selling. So what happens is that an investor could defer capital gains down the road continually until either they decide to sell the property and then pay their capital gains, or they would, if they passed away, then the heirs or the beneficiaries of the estate would inherit the property. And there's a term called a step up in basis, which means that no matter what the person paid for the property 20 years ago, 30 years ago, in subsequent trades, exchanges, that it steps up to the current value of the property in that year. So that means that it would virtually eliminate the capital gains taxes. Now, the capital gains taxes are somewhat misunderstood. So there's a capital gains rate, long-term capital gains rate that could be either 0, 15, or 20%. Then you also have another tax called a recapture of capital gains, a recapture of depreciation, which no matter if you take it on your income tax or not, the IRS considers that you are depreciating your property, not the land, but the structure, over a period of 27 and a half years if it's a residential property or 39 years if it's a commercial property. So on an annual basis, you have a depreciation schedule, and then you have to recapture that depreciation at a rate of 25%. So in basic terms, if you took $100,000 in depreciation, your tax rate of 25% would be $25,000. Then the other item, depending on your state of residence, you may have a state capital income tax low of 0% in 7 or 8 states, Florida, Texas, Tennessee, and a few others, up to the ceiling right now, I believe is 13.8 in California, but subject to change at any time, I guess. So that's a state capital gain, a state income tax. And then the little known net investment tax, or sometimes called Medicare tax, on higher owners is 3.8%. So you have a combination of all of those taxes that could be due on a piece of property. And in some states, it could be 50% of the proceeds. So you look at a way, how do you defer that capital gain? So you do it in a 1031 exchange. So that's vehicle number one. A 1033 exchange is a little bit different, has a little more uh, restrictive replacement rules, but has an expanded time period rule. 1033 exchanges are in the case of an eminent domain, where you have the government say, hey, we're going to take some of your property because we're going to expand the road. Or unfortunately, if you have your property destroyed by a fire or an earthquake or a hurricane or flood, and you get insurance proceeds, you can do a 1033 exchange. So those are the two IRS codes. So each one has their different nuances. There was a situation a couple of years ago where I had an investor in Louisiana who had a combination of a 1031 exchange on his land and a 1033 exchange on his building that was destroyed. So he sold the land to somebody else and he never redid the building. So he took the insurance proceeds and he did a 1033 exchange on that. So each individual situation is different. So what most investors have to understand is that the timing and the clock doesn't stop. There's only one time it stopped in California last year when they had some floods where they extended the deadlines on replacement properties. But in most cases, you have 45 days in a 1031 exchange to identify your properties and a total of 180 days. and those are calendar days. You don't get time off for weekends or holidays. Those are calendar days. So that becomes the first impediment to some people's ability to use these, is that they can't identify the properties within 45 days. So especially a couple of years ago, when we had such a strong seller's market, people were getting in line and trying to buy properties. And in a 1031 exchange, you may have a finite amount of funds. If you have $500,000 of proceeds from the sale of your relinquished property, most people are not going to spend more than that. Well, when it was a seller's market, the properties were getting bid up and up and up, and a lot of buyers found themselves at a loss for, how do I get a replacement property of a traditional real estate asset? So those are the two main items that people have come to us and said, "Hey, can you help me with my real estate sale or my eminent domain problem?" So that's a 1031 and 1033.
And tell us about DSTs as well.
Okay, so now Delaware Statutory Trusts, about 20 years ago, a real estate company out of Chicago, Inland Realty Corporation, petitioned the IRS to use fractional ownership in the form of Delaware Statutory Trusts as replacement properties for 1031 exchanges. So the Delaware Statutory Trust is a trust that's registered in Delaware. Delaware is a tax favored state. A lot of people, well, gosh, I don't know if they're out in California, but in Florida, you'll see a lot of big boats that are registered in Delaware because of some favorable tax. I don't own a big vessel, so I don't know all the intricacies, but I know that Delaware is a tax favored state. So Delaware Statutory Trust came about a little over 20 years ago. It enabled people to use a fractional interest in a property or beneficial interest in a property as an acceptable vehicle for 1031 exchange. So what does that mean? I mean, how many people do you own with? Well, you could own an apartment building. There's this multi-million dollar apartment structure. It's over $100 million in value. For most investors to get in to buy that one apartment building, it's nearly impossible. It's impossible. But through fractional ownership, if you have a $500,000 1031 exchange, you could own a piece of that building. There are stipulations. You have to be an accredited investor. An accredited investor means that you either qualify income-wise or you qualify on net worth. Each one has their different requirements, and either or. So if you're an accredited investor, you can purchase an interest, a beneficial interest in the apartment building, and then receive monthly distributions. And at the end of the cycle, when the building's sold, you get your pro rata share of any proceeds that would come out of the building. But the most important thing in those, the DSC enables you to defer your capital gains. So let me reflect back on an accredited investor. An accredited investor, from an income standpoint, either needs to have an annual income for the last couple of years of $200,000. If they're single, they're filing jointly, it's $300,000. So that's one way to qualify. The other is on a net worth. Excluding a primary residence, you have to have a net worth of $1 million. There are a couple of other exemptions to the accredited investors. If you are a financial advisor, a representative, you are also considered an accredited investor. So it has to do with knowledge in that aspect and financial for the individual investors. So the Delaware Statutory Trusts have been around for 20 years, and you'd be amazed at some of the types of properties, or we call them assets, that could be a Delaware Statutory Trust. From a multifamily standpoint, you have apartment complexes, you have student housing, you have senior housing, you have manufactured housing, and then you have self storage. You would have industrial, like some of the Amazon distribution centers or Ford Motor Parts distribution centers. They're Delaware Statutory Trusts. You have government buildings, Social Security buildings that could be Delaware Statutory Trusts. So these are a lot of them are high net worth credit tenants. So that it just depends on the type of assets that an individual investor feels comfortable with. For example, I have a couple right now. They're from California, and they've always owned apartment complexes. So they are very comfortable with owning apartment complexes or multifamilies as compared to maybe buying into a senior living facility, which is a combination. It's a business operation as well as real estate. And then other people may not want to get involved with self storage, although self storage year over year has been an incredibly stable asset class because, as everyone knows, we in America have a lot of junk. We want to store, we want to keep everything. Uh, about 20 years ago, my commercial partners and I owned a self storage facility, and occasionally you have to put a lock on someone's possessions that they don't pay you, and then you have to sell it and things of that nature. So it's always amazing. And this was before those Storage Wars TV program would come out.
Yeah.
And so we would open up the doors and we go, oh my gosh, they're saving Christmas decorations that are like 30 years old. They're paying $110 a month to store their Christmas decorations.
Yeah.
So self storage has always been a very good asset class for consideration. But once again, you're going to decide if it's an asset class that you want or a geographic location. Some of my folks that are in New York say, hey, I just want to buy in New England. And pretty much DSCs are located throughout the United States. So it just depends on where you want to loan and how many pieces of property you want to own in your portfolio.
I gotcha. And so all three of these vehicles, 1031, I guess 1031 and DST, you can only use those after you've sold real estate. Is that correct? Like if I just made $500,000 on my Amazon stock, I cannot take that and shelter the capital gains in a DST or 1031, correct?
That's a good point. So with the Tax Jobs Act that was passed at the end of 2017, 1031 exchange reclassified only for real estate, not personal property or stocks. Okay. So if you were to have a stock sale and was looking for a way to defer capital gains, an option may be as a result of the Tax and Jobs Act from 17, they created opportunity zones. Now, opportunity zones, when you contrast and compare them to 1031s, have a distinct difference. In a 1031 exchange, your financial requirements would be to, number one, buy equal or greater value. Number two, use all the cash proceeds from the sale. And number three, if there was a mortgage paid off on your loan, you have to replace that mortgage, which trips people up, which we can talk about. All right. Now, on the other side, if you went to a totally different strategy, an opportunity zone, to use your example, you sold $500,000 worth of Amazon stock, and congratulations that you sold that. You would take a look at that stock portfolio and determine what you paid for that stock and how much is what's known as your basis or cost basis in the stock, and then how much is your profit or your capital gains. You only need to reinvest the capital gains in an opportunity zone, and then you can retain your basis or your cost basis that you paid for that stock. Now, if you're a stock investor that had acquired the stock over time at different cost bases, hopefully you kept all your records so you would know, and they're typically, depending on how your accountant uses it, either first in first out or last in first out, however they want to determine that they calculate your capital gains. The capital gains is all you have to put into the opportunity zone. So why do we have opportunity zones? When the Tax and Jobs Act came out, they wanted to incentivize investors to invest in communities, which there were marginal areas, granted, and they enabled the governors of all the states to designate opportunity census tracts, which I think is kind of important because the census tracts were done in 2010. Fast forward 14 years later, some of these census tracts are the same, and some of them actually have improved. So it enables you, and there's 8,700 of these throughout the United States. And there's websites that shows where the opportunity zones are. But what they want to do is get the investors who have capital gains, rather than putting it in their pocket, to reinvest in opportunity zones. So in order to have the benefits of the opportunity zones, the tax benefits, you must be in the opportunity zone or area for a minimum of 10 years. That means that if you put $100,000 in an opportunity zone quote fund, and you keep it for 10 years, and that fund is now worth $200,000, you could take the $100,000 profit and not pay any capital gains. So that has resonated with some investors, that they're going into opportunity zones as individual investments or into opportunity zone funds. Now, there are always a few caveats. There are 3 or 4 states that do not recognize opportunity zones, and you may be thinking, I wonder if California is one that recognizes it. And no, they don't. So California and North Carolina, they don't recognize the opportunity funds right now. But having said that, here's the case. There's an investor who sold a piece of real estate. It was an $8 million sale. He had a mortgage of about $1.5 million on the property. He had a basis of $3 million that he had paid for the real estate. So he ends up selling a piece of property, and then he can move into an opportunity zone and keep his cost basis of $3 million in his pocket. In other words, just extracting it and then having to move all the capital gains into the opportunity zone. So the question is, when do you pay taxes? Well, the taxes are deferred until the end of calendar year 2026. So they're due by April 15th or so. Can't remember what day of the week that is. April 15th of 2027 is when your capital gains are due. There were a few other benefits that have expired, but the big benefit is if you keep it in for 10 years, any proceeds or profit from the opportunity zones come out tax-free. And they are all over the place.
I see. So like if I had
Now, did I confuse you enough?
yeah, I'm just gonna run through this scenario a little bit. So like that client had $3 million cost basis, 3.5 million in profit, puts the 3.5 million in an opportunity zone. That delays the capital gains 10 years, and any additional money he earns in that 10 years on that 3.5 million won't be taxed.
You're close. Let me interrupt you. If he put $3.5 million of capital gains into an opportunity zone, and let's say $3.5 million times, let's say he's got 20% capital gains. That's $700,000 that he has to pay in capital gains at the end of 2026. So it's just deferred to the end of 2026.
I see.
Now, there are strategies that some opportunity zone sponsors have that may create, especially if they're under construction, they're going to be cash flowing by the end of 2026. There may be opportunities to refinance the debt that's on the property so that there could be a liquidation event that provides some relief for the people that have to pay the capital gains. But in your example, you're taking $3 million of proceeds off the table that you should be able to invest and have some type of return for the next couple of years in order to pay those capital gains. So that's an important element. Capital gains are deferred at the end of the year. Now, regardless of what's going on in Congress, I know there is a bipartisan a bill someplace in Congress. Cory Booker, I think it's Cory Booker, and Tim Scott, South Carolina. They are trying to extend the tax deferral to the end of 2028. Whether or not that gets passed or not, I don't know.
So is it end of 2026 across the board for all DSTs, or is it 10 years from the time you put it in?
All right, now DSTs have nothing to do with the 2026. That's opportunity zones.
Oh yes, opportunity zone. Sorry, I flip flop.
Opportunity zones have the deferral to the end of 26, doable in April of 2027.
I see.
That's when your taxes are due. Okay, so the opportunity zones, and there's billions of dollars that have been moved into opportunity zones across the country. Now, granted, some of the locations, when you reflect on them and say, gosh, why is that an opportunity zone? This is in 2024. Well, understanding that it was the census tracts from 2010
I see. I
that
see.
they had that they were required to use. So some areas have already, I don't want to say make the turn, but yeah, more money was already going into those areas. So opportunity zones now have just accelerated, some of the success of that. However, let me say this, Tim. When I look at an opportunity zone, the underlying real estate deal needs to make sense. It has to pencil out. It has to be a good real estate deal. If they're projecting an income from a multifamily housing development, I have to look at, what are the demographics in the area, and is does a real estate deal make sense to begin with? I, I, unless the consumer investor is driving an acquisition of a property strictly for tax reasons, I kind of pull back on that. The deal's got to make sense. My real estate background says, hey, it's got to make sense. All the CCIM classes that I've taken, I'm a member of the Certified Commercial Investment Management Board. So it's got to make sense. You just don't want to invest just because you get a tax write-off. So which some of these deals had pretty healthy tax write-offs, not only in the opportunity zones, because some cities were providing additional tax incentive to promote growth in areas, which worked out as a benefit. It was a win-win for the investors, for the sponsors, and also for the cities that are going to be reaping the benefits from this.
Well, awesome. That was a masterclass on 1031, 1033 DST and opportunity zones. And so, continuing with our case study, you have the 3 million in basis, 3.5 million in capital gains. That went to the opportunity zone. That 700,000 that you would pay is deferred until end of 2026, paid April 15th, 2027, are due. And the 3 million in basis, you can go invest anywhere. You could put it back in the stock market. You could put it with somebody like Stallion Capital. You could put it with a private equity firm.
Absolutely. So some of my investors now, and a lot of it has to do with, no offense, age. Some of my younger investors, there's no question they could take on more risk than someone who's 80. Someone who's 80 just wants to say, hey, I want to preserve my capital. I mean, a lot of family offices are like that. They just want to preserve capital and they'll take a much smaller return. So yes, the $3 million could come out. And I know you have some debt funds, which debt has become in vogue these days with people that need lending. They need lending because a lot of the regional, well, I don't have to tell you, you guys know the regional banks are they're not lending builders. I have builders in Florida right now who have inventory houses that they've built, and especially for first time home buyers, where they're more sensitive to interest rates, that they have houses that they've slowed down the construction on because as soon as they finish their construction loans, they have to move to permanent mortgages. So builders are looking for, what are the sources of funding that I have? I mean, we're helping right now. We have well, I can't really give it away, but there are regional businesses that need source of funding, and whether or not they sell their property on a lease back, which if they need money for investing in their business or investing in their property, sometimes they have to sell their business and do a sale leasebacks in order to raise capital because the banks are not giving them. So kudos to you guys, because you have a source of funding that some of our builders in Florida would die for. But I think your phone, you have that sweet spot. What is it? 35? What's the road that you guys invest mostly on?
Yep. I-35. That's kind of just the beautiful, huge amount of growth that's coming into Texas is up and down the I-35 corridor from Dallas to San Antonio.
So that becomes a sweet spot.
Yeah.
From a geographic location, that's a sweet spot. Yeah.
Absolutely.
Yeah.
Absolutely. Yeah.
So I know that I have investors that are looking at sweet spots for states. They'll say, hey, I want to be in Nevada. I want to be in Texas, Tennessee, Florida. They want to be in the tax favored states as compared to some of the other states that don't have as much favorable, taxes from an income standpoint. You were mentioning about a case study. Let me give you the reason that I ended up moving more into the alternative space, specifically with Delaware Statutory Trust, than running the big deals. A good friend of mine who's a CPA by trade and a qualified intermediary as well, in Naples, Florida. It was in 2018, I think it was. He had called me and he said, and it was December 19th, 2018. He calls me. He says, "Al, are you doing anything tomorrow?" I go, "Well, I don't know. It's close to the holiday. What do you need?" He says, "Well, can you come to my office? I want you to meet somebody." I go, "Do you want to tip me off as what am I meeting?" "Well, it's somebody who sold a piece of property." That's all he told me. So I walk into his office. Tim, it was almost like I was going into a viewing. There's a husband and wife there, and there's the real estate agents there. And the gentleman said, "Al," my buddy says, "Al, I'll leave you. These people want to talk to you." So I make a long story short, which was a crazy story. The woman starts out, the wife of the husband starts out and points her finger at the real estate agent and says, "You convinced us to sell our property. You said we're going to do a 1031 exchange. You said there was no problem, and you collected the commission. Now we have 5 days left, and you can't find us anything to buy." Now, this was over a $7.4 million sale. He paid off a $2.5 million mortgage. He did a development deal. He was looking at when it was all said and done, about $1.5 million to $1.6 million in capital gains taxes. And the woman, the realtor, said, "Well, I found you something." And the wife of the husband, and the husband was stone cold silent. I got an eerie feeling from him, like, uh-oh, I shouldn't have done this. I'm meaning sold my business, sold my property. The wife looked at the realtor and said, "You want him to sign," because they have to replace the note. They have to replace the mortgage on a 1031 exchange. You want him to sign on another mortgage at his age." And she had a motion as if she was yanking a rope around the neck. And she said, "This will be the noose around his neck." Well, with 3 or 4 days left in their identification period, for me to help them, it was next to impossible. So I said to myself, okay, there must be a way, there must be a product, there must be something to help people that are at the end of the 45 days, almost like the end of your rope, to make the replacement properties easier. So that's what happens with the Delaware Statutory Trust. So Delaware Statutory Trusts are prepackaged. The sponsors arrange for a debt assignment, which is considered non-recourse debt to the investors. So if he had to replace the $2 million debt, he would get that $2 million assigned to him as a non-recourse position, meaning he doesn't have to apply for it, meaning there's no other assets that he has that's get attached to that debt, unlike other types of loans. And his capital gains are deferred, and he doesn't have to stroke a check for it. And at his age of mid-70s, or at that time, going back a number of years, it would have been the perfect scenario. However, the educational process for Delaware Statutory Trust doesn't happen overnight. I mean, there is a learning curve. Like any other new process, there's a learning curve. It's been around for about 21 years now, but there's still a learning curve for investors to understand. Now, there are CPAs out there that understand the process. Not only do they understand the 1031 process, but they end up understanding what Delaware Statutory Trusts were. Now, fast forward, it was 2 years ago. It was around August 5th, and I get a call from an investor from Texas, and she starts out and she says, "Mr. DiNicola, my real estate broker and I have been looking even before we closed on our relinquished property, and we can't find anything. So what do you think happened?" DSTs are prepackaged. I had it all on the shelf. We
Yep.
ended up within a period of 5 days, we ended up identifying 13 potential properties that she could purchase. 13. Because, like other advisors, if you're in this space, you track the sponsors. Weekly, I review all new products. Weekly, I know what the amending balances are for each DST product that I track. So within a period of 5 days, 13 were identified. She ended up closing on 7 of them. And that was another pretty good sized deal that she ended up doing. But unfortunately, at that point in time, a couple of years ago, the real estate brokers couldn't find anything further to buy. And plus, she didn't feel like signing on the loans for the debt replacement. So 2 different case studies. It prompted me to get into the business, understanding that I couldn't help my friend, the CPA and QI, out with the people that he was dealing with. So that's sort of the long roundabout way of giving you some insight. Hope I didn't bore you on the details, Tim.
No, I loved it. It was a fantastic case study. And I mean, I was going to ask another question about replacing the debt via 1031, but you just spoke to it in the DST case study. So
Yeah, the requirement in the DST is you have to replace the debt. In the opportunity zone, you don't have to replace the debt, but they're 2 different strategies, 2 different types of investors.
well, awesome. Al, this really has been a masterclass on the real estate strategies for people who, maybe want to avoid some capital gains. And I even like that we touched on the opportunity zones of like sold your business, sold some stock. Opportunity zones are an option. Now, I guess here's my question. At 2026, when they are kind of deferring the taxes until that point, will the whole program get restructured? Will the opportunity zones change? Will it be around in 2035 in the same way it is now?
The opportunity zones will probably be around past 2035. Here's the capital raise for opportunity zones. The 10-year holding period starts when the last funds are deposited in the opportunity zone. So, for example, there's I can't talk about active deals, but there's a deal right now that was a 35 or $40 million capital raise, and they're down to the last $2 million. So they're going to raise that capital at the end of probably May. So by the end of May of 2024, they have to keep it for 10 years. So the investors that got in 8 months ago, whatever, their time doesn't start when they put their money in. Their time starts when the last dollar is raised. So the criteria for an opportunity zone, if you raise 35, $40 million, you have to invest another 35 or $40 million. So most of the opportunity zones are structured where there are loans in place so that you have to develop the properties so opportunity zones are for developing properties for businesses. Now that's not to say I had an individual from North Carolina who looked up opportunity zones in North Carolina because he wanted to stay there, even though North Carolina doesn't participate, but on the state level, but federally they do. He ended up and purchased a $150,000 house. He had to improve that property by $150,001. So you have to invest additional proceeds in the opportunity zone. You just can't park cash amounts, capital gains. It has to be your capital gains plus an additional investment into that opportunity zone.
Makes a lot of sense. Well, Al, thanks so much for coming on the show. I think that's all we have for you.
Call me if you need me.
Well, Al, if people want to know more about you or more about what you do, where should they go to find you?
Naples Asset Management or NAMCOA.com. That's probably the easiest way to get a hold of it. That's NAMCOA.com.
Al, thank you for coming on the show. Everybody else, thank you for watching, and we will see you guys on the next one.